Hey, what's going on YouTube? Welcome back to another day, another video, and my investing channel. As usual, I'm your host Calvin. And before we get started, if you could show your support, scroll down, hit the subscribe button. I definitely really appreciate it, and I love all the support I can get. With that being said, I am not a financial expert or an advisor, so please reach out to one before you begin to invest. Or you could just do your due diligence and make sure to become well informed. But I would recommend reaching out to an advisor if you do plan on investing. So today is going to be a little bit different. Rather than having a clear-cut analysis, it's going to be more of sort of me discussing some of the market conditions in more of a seminar type manner. So let's just jump right in. So I kind of wanted to talk about the state of the market and what's really going on. So you can see this is from the end of last week. On Friday, the market opened up pretty red. It bled and then it reversed. Part of that had to do with some of the comments made by the Fed and by J Powell. But I think we're also seeing a different way companies are going to be valued going forward. So what happened since the pandemic began was since the flash crash for the pandemic began was that there were really low interest rates, the yields fell, and tech companies were getting insane valuations. You saw companies run 10, 20, 30 times of what it was pre-pandemic. And then you also saw, or from its lows in the pandemic, not pre-pandemic prices, but you saw these companies run incredibly high. And these valuations weren't necessarily justified by sort of the revenue the companies were making, or it was more speculative in nature. For example, you had NEO go from a $2 stock to a $60 stock. That's a 30 times increase. It increased 30-fold from what it was about a year ago. And that's absolutely insane, right? The company does have significant growth, significant advances in revenue, but to have that type of valuation off the bat was definitely very wild. Tesla, for example, is another company that has an insane PE ratio, if people even look at that. And the thing is I'm not saying these companies are overvalued or undervalued, but these companies these companies have had their valuation reset to kind of adhere to sort of the market conditions. So what we're seeing is a lot of people move money out of tech stocks and into some of more of the quote-unquote reopening stocks, such as a lot of energy, oil, travel, and theme parks, theaters, etc. So we're going to take a quick look at QQQ. This is the tech ETF. It's what was it trading? Its high was around 338. Let's see. Let me draw a line here to see. Was trading around here, and this was February 16th. So just about 2 weeks ago. And today, or on Friday, it hit a low of 297 before closing at 308. So you can see that this is a $40 drop. It's not alarming, right? It's a $40 drop compared to, right here was 237 and it ended up 170. It's about a $70 drop, and then it climbed up from right here, 308, or this is about 303. This is about 260. So there have been occasional drops that are like $40, $50 resets. So as long as it's not dropping from all the way down, this is about an $80 move. As long as it's about $40, I think we're still relatively safe. But in reverse, as tech is dropping, you can see that oil has kind of risen in the last. Let me see if I can go a little closer. the last 3 days, when tech is right here, it's falling. Oil is going up. Part of it is due to OPEC, but if you look at the last month, USO, which is an oil ETF, has jumped from about, let's go to February 1st. Has jumped from about $35 to about almost $45. That's almost a $10 move within a month for an oil ETF, which is pretty crazy. You don't see such large moves in sort of stable sectors. So this kind of shows me that a rotation out of tech and into sort of the consumer cyclicals or the foundational stocks, which provide infrastructure for the economy, is where the money's kind of moving into at the moment. This could give you a couple of things. This could be an opportunity to buy the dip in tech if you're a strong believer. There's still bargains. There's always going to be bargains. Tech stocks are very speculative in nature, but there's a lot of different tech stocks with massive potential. Or you could try to ride the wave, jump into some energy, jump into some travel, maybe ride the next month, see if it goes up, and then sell out of your shares or hold it for the long run. What coincides with a lot of travel energy stocks are that they're relatively stable in nature over a long period of time, and most of them do pay a solid dividend. So as a dividend investor, I have an account that's dedicated towards dividend investing, and I bought the dip last year, picked up a lot of ExxonMobil, Wells Fargo, banks, other oil, Chevron, Simon Properties Group, just a lot of various companies that are going to be fundamental, that are going to come back in the next couple of years. So, there's definitely two different methods you can go after, and so forth. So you can see that this is a weird phenomenon where oil is going up. Let's see, while the market is kind of falling down. And you can also see that with, let's go look at Jets, the airline ETF. You can see that although it did drop, like $2 recently, before bouncing back up to $25.71, just about a month ago, this was only trading at $21. So almost a $5 jump in about a month is pretty wild. So especially for the Jets ETF, which is composed of the U.S. airlines and other various airlines. So that's kind of what's going on. So last of all, I would like to kind of talk a little bit about the state of the stimulus and the economy. So I think let's look up the stimulus. So, okay, we'll just pull up a rough one. All right, so CNN, it's going to be $1,400 per person, and a family of four can receive up to $5,600. So where I think this is kind of has some gray area is that if unemployment is decreasing, all these numbers are decreasing, is giving out $1,400 the best idea? And I know a lot of people need the money. I'm not saying don't hand out $1,400, but I think for the people that are unemployed, the government should pivot and use and build infrastructure to hire these people. You can give them the $1,400, but also attach other methods to give them sustainable income versus one lump sum payment that doesn't do anything over time. If you're still struggling, or if people that are in positions of struggle, I think it'd be better suited if the government set up proper infrastructure to really provide meaningful employment in addition to giving you financial aid. That could go a long way, and I think that would definitely speed up the recovery. At the same time, the government has kind of given a lot of hints that, hey, we're starting to see inflation, we're starting to see signs of growth, the economy's coming back. and so forth. So I'm just speculating and wondering when is when's the Federal Reserve gonna stop expanding their balance sheets. So right now they're kind of employing a strategy known as monetary expansionary policy, which means that the Fed is injecting money into the market by buying bonds, and they're basically providing funds as well as offering low interest rates, so people can actually, or big companies theoretically could borrow money from the federal bank. So, with this being said, thank you guys so much for tuning in today. This is just kind of my couple of scattered thoughts on the market. Travel and reopening stocks are getting a nice rotation, while tech stocks are taking a beating. I did provide a couple of inputs about how I might or may not plan on trading for the next couple weeks. I might try to get into the reopening stock wave, or I might just kind of stand pat and see where the market goes. I will say this though, whatever happens or has happened to the market for reopening stocks, some of these companies are always going to be fundamental to the United States economy and the global economy. So I don't see companies such as ExxonMobil, Chevron, Shell, BP, United Airlines, going anywhere anytime soon. I think they're here to stay, and that was my thought during the onset of COVID, and that's still my thought now. So I think that these travel stocks will see a massive amount of hype, especially when things start to get a little bit better. I think there's going to be a crazy craze for excuse me for using that term, crazy craze. That doesn't really help. There's going to be sort of a huge hype and pent up demand for travel. So we can see sky high prices for plane tickets, sky high numbers for flyers, resort visitors, travelers. Once the world starts to reopen itself up, in the next couple of years, I think there's going to be a massive influx of travel, and that's kind of when I hope that travel stocks are gonna pop off. I may look to let go of a couple of shares, or I may continue to add shares. I'm not sure what I'm going to do yet. As of right now, I'm constantly adding Disney stock. So I'm a huge fan of Disney stock, and I'm adding a couple shares a month. I think that their brand, the media, Disney Plus, provide a lot of value. I think they can be valued somewhere close to Netflix in terms of their content. Not market cap, but I think, like, to me, their ability to produce content, not acquire but produce content, is going to be unparalleled. And I think Disney is going to be one of the top 5 to 10 most valuable companies in the future. So, all right, guys, thank you guys for tuning in. If you can scroll down, hit the subscribe button. I appreciate all the support. Feel free to leave me comments, and I hope to connect with you guys sometime soon. Thank you so much.